Hello students, now let us see ratio analysis, specifically the activity ratios. The different activity ratios are stock turnover ratio, debtor turnover ratio, creditor turnover ratio, working capital turnover ratio, fixed assets turnover ratio, current assets turnover ratio and total assets turnover ratio. Now let us see the different formulas of activity ratio. Inventory turnover ratio is equal to cost of goods sold divided by average stock. Cost of goods sold is equal to sales minus gross profit or opening stock plus purchases minus closing stock. Average stock is equal to opening stock plus closing stock divided by 2. Debtor turnover ratio is equal to net credit sales divided by average debtors. Average debtors is equal to opening balance plus closing balance divided by 2. Creditor turnover ratio is equal to net credit purchases divided by average creditors. Average creditors is equal to opening balance plus closing balance divided by 2. Average payment period is equal to number of working days divided by creditor turnover ratio. Working capital turnover ratio is equal to cost of sales divided by average working capital. Average working capital is equal to opening plus closing working capital divided by 2. Fixed asset turnover ratio is equal to net sales divided by fixed assets. Total asset turnover ratio is equal to net sales divided by total assets. Now let us see how activity ratio is calculated with example. Here the balance sheet is given of a company and in which we have to calculate capital turnover ratio, fixed assets turnover ratio, working capital turnover ratio, current asset turnover ratio and total asset turnover ratio. Now let us see how calculation is done. Capital turnover ratio is equal to cost of goods sold divided by capital employed. Now let us see how it has been calculated. Fixed asset is equal to 1,60,000, in which we have added current assets, that is debtors, bills receivable and cash. Debtors is equal to 60,000, bills receivable 20,000 and cash 50,000. The total is 1,30,000. And current liabilities, that is creditors and bills payable, 40,000 plus 20,000. Now we have deducted current liabilities from the current assets, that is 1,30,000 minus 60,000. The total is 1,70,000. Now we have added 1,60,000 and 70,000, that is 2,30,000. This is capital employed. The other way of calculating capital employed is equal to general reserve, that is share capital, that is 80,000, general reserve 30,000, profit and loss account 50,000 and mortgage loan 80,000. The total is 2,40,000, in which preliminary expenses 10,000 is deducted. The answer is 2,30,000. Now the capital turnover ratio is 1,20,000, that is cost of goods sold divided by capital employed is 2,30,000. The cost of goods sold is calculated by sales minus gross profit. Sales is 1,60,000, in which gross profit 25% is being deducted. The total is 1,20,000. Fixed asset turnover ratio is equal to cost of goods sold divided by fixed assets. Cost of goods sold is 1,20,000 and fixed assets as given in the question is 1,60,000, that is equal to 0.75 times. Working capital turnover ratio is equal to cost of goods sold divided by working capital. Cost of goods sold is equal to 1,20,000 divided by working capital, that is 70,000, 1.71 times. Working capital is equal to current assets minus current liabilities. Current asset turnover ratio is equal to cost of goods sold divided by current asset. Cost of goods sold is 1,20,000 and current assets are 1,30,000 as we have calculated above. The answer is 0.92 times. Total asset turnover ratio is equal to cost of goods sold divided by total asset. Cost of goods sold is 1,20,000 divided by total assets is equal to 2,90,000, that is equal to 0.41 times. In this way we calculate the different turnover ratios. Thank you.